So we have just witnessed the collapse of Silicon Valley Bank, the 16th largest bank in the United States, who have now become the largest bank to collapse since the global financial crisis in 2008. Now, Silicon Valley Bank is one of the largest banks to operate in Silicon Valley and is a well-established financial organisation that's been operating for 40 years, so not exactly a new player in the banking world. Now, as of last week, the bank had 8,500 employees and over 40,000 clients that included startups, venture capital firms and private equity firms as well, all of which amounted to around $170 billion in assets under the bank's control. 44% of all venture-backed US tech companies banked with Silicon Valley Bank, including some big names like Shopify and Roku. Now, the collapse of Silicon Valley Bank was quite extraordinary and seemed to come out of the blue without any real warning, with the start to finish of the collapse only really taken a couple of days. So what actually happened to cause this? So Silicon Valley Bank started to invest tens of billions of dollars, a relatively large portion of their total deposits, into US Treasuries. Now, this is quite an acceptable strategy on the surface and usually a very risk-free way to earn a fixed income on your money while having a very low risk of the bonds defaulting. Now, if the market value of these bonds falls, it usually doesn't matter too much because banks do not have to report their paper losses, so if they just continue to hold their securities until maturity, then they will be fine. But when you take a look at how bonds have been performing recently, you'll notice that the performance has been extremely poor, especially for an asset class that is usually quite safe and has low volatility. Now, looking at TLT, for example, an ETF that tracks the performance of 20-year Treasury bonds, we can see that the bond values are down close to 40% over the last few years, with most of these losses coming in the last year and a half since the end of 2021. Now, over the same time period, many of these unprofitable tech companies that bank with SVB were finding it harder and harder to raise cash due to the high interest rate environment, leading to less money being deposited with the bank and also a much higher rate of withdrawals. Now, after all, most of these companies have negative cash flow and/or are unprofitable. So if they are not raising any new cash, then they still need to keep taking out existing cash out of the bank for the purpose of paying staff and also continuing their operations in general. Now, because of these increased withdrawals, SVB were forced to start selling off their treasuries in order to continue paying out on these withdrawals. Now, on March the 8th, SVB did sell $21 billion in securities at a $1.8 billion loss, turning paper losses into actual recorded and real losses visible to all. The bank also decided that they urgently needed to raise cash to avoid this problem continuing, and so issued $2.25 billion worth of new shares on the market, which was simply too much for investors to handle, tanking the share price of SVB, while also raising massive red flags to companies that currently were banking with them, leading to a rapid increase in withdrawals from the bank. Now, these withdrawals were only exacerbated when various groups and prominent individuals in the VC and startup world did urge companies to move their money out of SVB, culminating with Gary Tan, the CEO of Y Combinator, warning their entire network of startups about the insolvency risk that they could be facing with the bank and that they should consider limiting exposure to SVB full stop. Now, shortly after this, the share price did plummet by over 70% in the space of a couple of days, and SVB realised that nothing more could really be done to save the bank, leading to the US banking regulators to come in and shut down the entire operation. And this meant that SVB went from a market cap of $16 billion to complete collapse in a matter of days, which is a truly insane meltdown. Now, where does this leave the firms and individuals that had been caught up in this SVB mess? Well, under normal circumstances, only the first $250,000 in deposits at any bank is insured, meaning that this is all customers would be guaranteed to get back normally. However, on Sunday night, in a joint statement by the Fed, Treasury and the FDIC, it was announced that all depositors for Silicon Valley Bank will be able to access their money by Monday. It was also announced that another large US bank called Signature Bank had been shut down by state authorities as well, but once again the Fed will be bailing them out and depositors will regain access to their money next week. The question is, how many other banks are going to be impacted by this whole mess, and will we see more US banks collapse in the coming days, weeks or months? Well, unfortunately, I believe that there is a decent chance that this does happen. Many US bank stock prices have taken big hits over the last few days as fear around the entire sector has been spreading. Now, this does include big names like Bank of America, Wells Fargo, Goldman Sachs, Citigroup, and also JP Morgan, who are all down quite considerably over the last week or so. And also Charles Schwab have also suffered a major sell-off as investors feared that they could be in trouble as well. But there were also a number of regional banks, just like Silicon Valley Bank and Signature Bank, that were down massively, including the likes of PacWest Bancorp, Western Alliance Bancorp, and First Republic Bank, just to name a few. Now, if SVB can essentially go bankrupt because of bond prices falling and depositors withdrawing their money, then why can't this happen again to other banks as well, especially the banks that are a bit smaller and have a more risky asset allocation? Now, one thing that is very concerning is that at the beginning of the pandemic, the Fed suspended the reserve requirement for banks, which typically meant that every bank had to hold at least 10% of all deposits on hand somewhere that was immediately accessible. Now, this was sort of understandable at the time, given how crazy the economy was for those first few months of the pandemic. However, the reserve requirement has remained suspended ever since and was never re-implemented. Now, this hasn't really been spoken about much due to the fact that we haven't really seen any banks get into trouble over the last couple of years, but now we are seeing this carnage take place within the banking world. It's worth highlighting again, as this could potentially lead to more problems in the future. Now, having a lower percentage of deposits on hand to give to clients withdrawing money means that a bank run is more likely. Now, with all the negative media attention that banks are getting right now, it's not unreasonable to assume that many individuals as well as corporations across America could be rather spooked by this whole situation and start to withdraw their cash out of banks. Now, when you combine both of these things together, banks having a low percentage of deposits on hand to give out to clients and an increased rate of withdrawals from these banks across the whole of America, this could spell disaster in the coming weeks and months if something is not done to resolve it. Now, of course, with US Treasuries continuing to offer a higher rate of return compared to what you would get in interest at many banks, then this also continues to shift the balance away from keeping cash in a bank and does not work in favour of the banks. Additionally, if bank deposits are essentially now being insured 100% by the government who are bailing out both of these failing banks, then what sort of risk does this encourage the banks to start taking on if they know that customers will get their money back 100% if it all goes wrong? Now, bank managers can therefore take major risks with their asset allocation with lower potential consequences, knowing that the US government will step in and bail them out if it all goes wrong, and they can take these risks in an attempt to score the most profit and be rewarded with a bigger bonus. Now, if we continue to see more and more bank runs, which is very possible, then the US government and the FDIC simply does not have anywhere near enough money in order to pay out on all of these deposits 100%. Now, the emergency funding program that the US government is setting up to cover these banks could therefore plunge them into even more debt, in which we will see trillions of dollars in new money be required to be printed in order to cover all of this mess. To add to this whole situation has led to the US being 3 times more likely to default on their debt, and also the chances of there being no more rate hikes has rapidly shot up, now becoming the most likely scenario. Now, if there are no more rate hikes that take place, then this could spell disaster for the US economy because it would mean that inflation was not being dealt with properly due to how fragile the banking system is. Now, if there really is no way to hike any higher than what we are currently at without the whole banking system collapsing, then this really does send a quite negative sign on the current state of the economic situation in the US. Another thing to note is that the top dogs in US banking, like JP Morgan, Citibank and Goldman Sachs, are enjoying an influx of new deposits, most likely due to individuals and businesses taking their money out of smaller banks and moving them to the largest banks because they logically have a lower chance of failing. Now, this really does make me wonder how much damage this could cause in the future to any bank that is not inside the top 10 in terms of size and credibility. If everyone starts pulling their money out of these smaller banks, then we really could see multiple bank runs in the future, meaning multiple more banks that the US government will need to bail out, and as we've already established, this may not be possible due to how much money it will cost. Now, obviously, if we see many bank runs in the next few months and the US government has to default on their debt and also cannot afford to keep bailing out the banks, then this is a very dark potential future scenario that we could be facing across the US. But obviously there's probably a high percentage chance that this doesn't happen, and we can all certainly hope that this does not happen, and that in fact this is the end of the mess for now, and it's just these two banks that are going to fail. And yeah, hopefully there's no more banking failures and no more bailouts that will be required. Another concerning thing for the US economy is the amount of mortgage delinquencies and foreclosures that we are facing in the coming months that could drive the housing market down and lead to phase 2 of a great housing market crash. I made a more detailed video on this topic in my previous video, which you can check out by clicking on the screen right now. Aside from that, please leave a like on the video if you enjoyed it, that does help out the channel a lot. Also drop me a comment as well, let me know what your thoughts are on the whole banking situation and how you think it will pan out in the coming months and years. And also be sure to subscribe as well if you want to see more videos similar to this in the future, and thanks a lot for watching.